Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclicode.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He's speaking to us from Vancouver. Welcome back to the show, Bob.
Yeah, hi, Jim. And we're sitting here this morning with beautiful weather and a beautiful forecast for the next few days. Can't beat that.
Yeah, so our highs, 27 degrees, high 70s, low 80s for people in Fahrenheit. In Ontario, it's 40 degrees. Around Toronto, that's 104 Fahrenheit.
Yeah.
Yeah, they always say Toronto's hot and muggy, but now it's just miserable.
Yeah, well, it's there's what they call, at least they're starting to get a description right. It's a heat, they're calling them a heat dome. And when the high pressure area gets parked, then the heat builds.
Yep.
So, yeah.
We'll kick off the show with a listener question from Andrew. Andrew writes, I clearly remember last year Jeffrey Gundlach made the point that the Fed raised rates in 2018 despite inflation not justifying it. Now he's saying there's no reason to lower rates as Western central banks are all ready to hand out rate cuts like Oprah hands out brand new cars. I know Bob has his ears closely monitoring the markets at all times. Does he already hear the beats in the distance that precede the lyrics when it comes crashing down and it hurts inside, or will these rate cuts supercharge the markets one more time?
Andrew, that's a very good piece, and it has, the issue of what short-term rates do in a business cycle seems to be very puzzling to central bankers and those who watch central bankers. And the intuition is that when short rates go down, things will get better, included in your little note. But if you look at the history of interest rates, of which you can get T-bill rates in the U.S. 3-month or 6-month, we can get them at key times going decades back. And then also I was able to find T-bill rates in England at key market turns on big bubbles ages ago, from long time ago. Now here's the way it works. Short rates go up during a boom, and the Fed doesn't move the rates up. It follows the rates up, trying to look in charge. And also, your note implies that when short rates move up by market forces, it's anticipating a tightening by the Fed. Now, that's no. The Fed follows interest rates. Now, rising short rates with a stock and business boom, it's an indicator. For God's sakes, short rates going up is good. Now, what happens when short rates go down? You're in a depression, or bust, a cyclical recession, or you could be even in a depression. So, and I've charted way back, and the worst thing that can happen as a boom completes is when short rates start to fall. Now, in 1929, the 3-month T-bill peaked at around 5% in May, June that year. and started their decline. And when they started decline, it said that that boom was over, and the Fed didn't make a rate cut until late October. So now I'm looking at the short rates, and a major high was set a year ago, but it's more interesting now where the high of, say, in the last few months, and the T-bill rate has just backed off a little. Now, it's set a new low, but you can't say the trend has changed. Now, and I watch it at least daily, and when the downtrend in the T-bill rate is evident, then it says we're in a contraction, and stock and bond prices will turn ugly, particularly junk, and it will force the Fed eventually to cut their administered rates. Now, here again, we're going to emphasize this one, that at the moment, the street is saying that when Fed cuts arrive, it'll be great. History, going back generations, shows that when short rates and central bank administered rates go down, it is in a recession. So let's just put that one by the by, and it's why people come out in high places and say these things without first doing the research is beyond me. But hey, if they want to play naked in traffic, that's what they're doing.
Now, we'll take a look at some of the headlines that caught your eye, and there's two headlines that are related to this. The headline, it's the Fed that's a risk to financial stability.
Yeah.
Can you explain that one, Bob?
Yeah.
Because the whole idea of the Fed was...
You've had periods when the U.S. did not have a central bank. And it was also on the greenback inflation in the 1860s. But no. And guess what? Interest rates went up with the boom, and then interest rates went down with the bust. Now, what the Fed has done, and all other central banks have done, is that they are arbitrary, and they do have some influence over a long time. And there's only one, if the Federal Reserve did nothing, it wouldn't justify its existence. So Fedsters, in order to justify their existence, have to do something. And the only something they can do is to provide credit. So they have no sophisticated forecasting techniques. They don't understand financial history. So their dread always is that a recession is at hand at any time, and they also dread that a recession can turn into a depression. No, you need about 11 business cycles before you get to the one that leads to the depression, and I think we're there now, but we'll see on that. So the Fed in artificially and arbitrarily putting in credit over all of the decades has depreciated the U.S. dollar, so that it now has it's given up. It only has about 3% of the purchasing power it had in 1913 before the Fed. So, and this is distinctive because it's given us 100 years of price inflation, and the last time the senior economy suffered that was from 1500 to the early 1600s. So, hey, it's a major effort. They don't know what they've accomplished, but they have accomplished a century of inflation. I've called them tyrannical centuries because the feature of these has been war, too much war on countries, and then effectively the state declaring war on its own citizens, overly taxed, and taxation's not enough, so then they depreciate the currency. So, it's an evil business. It's been an evil century. But one of the things that brings it to an end is a huge boom in commodities and everything, like we're getting now, a huge inflation. And then when it cracks, the game's all over and you go into a major contraction. So this is, as I say, the last time one of these happened was in the 1500s. And it looks like current history is tracking on the way to a major contraction. And political reform, by the way, yeah. So, yeah.
Well, remember, Bob, when inflation started peeking its head up from under the rocks again, the Fed kept declaring, it's just transitory, don't worry, nothing to see here, move on.
Yeah.
Bank of Canada, same thing. Tiff Macklin, 2 minutes for missing the puck. Also a headline concerning the Fed from Breitbart, Fed sees higher rates forever.
Yeah, that one's really quite colorful. I read the bit of the article with it, but it's just somebody came up with a good headline, and if the boom continues, and with China in a recession, the whatever strength in the U.S. economy is probably going to fade over the next 6 months. So, it was a good headline.
We'll take a look at more of the headlines that caught Bob's eye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Headline, a new copper super cycle is emerging. You mentioned that before we went to break.
Yeah. There's a group of, we call them permeables in commodities. And their favorite term is a commodity super cycle where they really fly up. Now, the latest reasoning on this one, the reasoning is that, we've got consumer price inflation, therefore it's going to drive commodity prices up. No. The way it goes is certain commodities go up, most commodities go up, the wholesale price index or the producer price index goes up, then the CPI goes up, and then you have consumer price inflation. That's the way it works. Consumer price, CPI inflation doesn't drive up commodity prices. It's the result thereof. So let's take a look at the concept of this super cycle for commodities. It happened in 2008. These guys are so ignorant of history that they didn't realize it, and I can demonstrate it because we follow closely the base metal prices in London. And I came across an index of base metal prices deflated by the producer price index. It was a 100-year chart. And the gains in lead or zinc or copper deflated by the PPI to 2008 were huge. That was the highest in 100 years. And not only was the percent gain on the thrust outstanding, there had been nothing like it in 100 years. Crude oil got up to $147. You remember that. And then, of course, it got hit. And then the secondary rally took the CRB up in 2011, but not nearly as high. So there's historical evidence says that 2008 was the culmination of the super cycle. So now what else can history tell us is that on 4 out of the 5 previous great bubbles back to 1720. Once the bubble was completed, it was typically followed by a 20-year Great Depression. Yeah, the usual 3 to 4 year business cycle prevailed, but the recoveries were very weak and the recessions were quite noticeable. So any of these spokesmen on these issues who are flying on intuition, I mean, they can get, it's all there. You can go and study history and look at the recurring patterns and end up with at least a better informed understanding of what's going on.
Two headlines that appear to be related as well. Nvidia, Apple, and GameStop are the entire stock market right now, and that's dangerous. And another headline, top tech trio melts up to record highs. It's impossible to melt up. Who came up with that? Things melt down. Top tech trio melts up to record highs as the rest of the market and Europe burns. So, yes, you have Nvidia, Apple, and Microsoft leading the charge, and that's it.
Well, a little while ago it was the Magnificent Seven. Now it's the Magnificent Three. But one of the things that measures the health of a stock market advance is the overall advance declines. Like all of the stocks that are going up and all of the stocks are going down, and if the advance decline line is going up, it's a healthy market. Now, the 80s peaked, a couple of months ago and are rolling over. Now, this is also with the fact that here you got, at one time it was 7 magnificent stocks, so now it's only 3. And you can say the advanced declines are failing. So, and that's ADs are a very good clock on things, and the real NYSE AD line is rolling over as we speak, and that is a very good warning on the indexes. But it's so unfashionable to have a crash in the summer. So it's likely to do the round. But this one gives me a chance to point out that this summer, Jim, is going to be very typical summer. The media on a rally will call it a typical summer rally. And then when it gets a correction or a hit, it will, of course, be called typical summer doldrums. So I'm very confident we're going to have a typical summer.
Headline, Goldman, frustration grows with the lack of participation from non-Magnificent Seven stocks.
Oh, yeah. No, that's another way of saying what we've been talking about. The market the breadth is not participating with the leaders. They're out there all by themselves.
France, Italy among 7 EU nations to be reprimanded. Naughty, naughty. What did they do? What did they do, Bob?
I read the article, and they're borrowing too much money, that sort of stuff. So,
well, that makes them like every other government.
Oh, I know, and then eventually the credit markets stop supporting them, and then they got a problem, and there will be debt written off issues, not just country bond issues, but corporate junk bond issues. It just gets to be awful, defaults and write-downs and stuff like that. So junk bonds, you can figure, are going to go, many of them are going to default, in which case their prices will be no bid. Yeah.
Well, bargain hunter nowhere to be seen in French bond market is the headline.
Yeah.
Yeah, so what does that mean? People are just saying those French bonds, they stink?
They don't want to buy them, they won't buy them. Yeah.
And AI fever drives Nvidia to the world's most expensive company. They're over $3 trillion.
$3 trillion. It is staggering. When I came into the business a very long time ago, the biggest private deal was when Howard Hughes sold TWA Airlines, and I think there was a $400 million bond with that one, and that was considered huge. And now you're talking stock market caps at over $3 trillion. It's mind-boggling. It truly is.
Bob, always fun to chat.
Yeah, Jim, good to be with you, and looking forward to getting together next week.
As we celebrate Canada Day.
Oh, yes, you're right on that. I don't keep track of it too closely, but my daughter will remind me of it as it comes along.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on X @HoweStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.